you don't see it happen. There's no headline that says reset begins today. No official announcement, no sirens. Just small things. Currencies wobble. Prices move strangely. Assets that once felt safe stop behaving that way. And then one day, quietly, the rules you thought you understood about money no longer apply. Because every few decades, the system doesn't crash. It resets. And when it does, wealth doesn't disappear. It moves. Right now, most people are focused on what to buy. Gold, stocks, crypto, real estate. But history suggests a more uncomfortable question. What should you be selling before it's too late? Because some assets don't just underperform during a reset. They trap you. They lock you in place while everything else shifts around you. And by the time you realize it, you're holding something that used to be valuable. To understand this, you have to step back. Zoom out. Way out. Because the dollar reset isn't a conspiracy theory. It's a pattern. 1944.
The world is exhausted from war. Currencies are unstable. Trust is low. So leaders gather and create a new system. The dollar becomes the center. Not because it's perfect, but because it's backed. Gold sits underneath it like a foundation. $35 per ounce. Fixed. Stable. Predictable. And for a while, it works. Then 1971 happens. Quietly. Almost casually. The link between the dollar and gold is cut. No more anchor. No more limit. From that moment on, money becomes elastic, expandable. And over time, that elasticity becomes policy. Now fast forward. Debt levels explode. Governments spend more than they earn. Central banks step in. Lower rates, print money, stabilize markets. Again and again. Until one day, the system becomes dependent.
And today, that imbalance is everywhere. Global debt sits at levels that can't realistically be repaid. Currencies compete in a quiet race to devalue. Inflation appears, disappears, then reappears in new places. And beneath it all, one question lingers. What happens when confidence starts to crack? Because a currency is not backed by gold anymore. It's backed by belief. And belief is fragile. Now here's where it gets uncomfortable. During these transitions, not all assets behave equally. Some rise, some fall, and some trap the people holding them. Let's start with the first one, cash. That sounds strange, right? Cash feels safe, stable, liquid. It doesn't fluctuate like stocks. It doesn't crash overnight. But that's the illusion. Because during a reset, cash doesn't collapse dramatically. It erodes quietly. Think about inflation not as a number, but as a leak. Slow, persistent, almost invisible. Until one day you realize your purchasing power isn't what it used to be. And the problem isn't just inflation. It's policy. When debt gets too high, there are only a few ways out. Default, growth, or devaluation. And historically, devaluation is the most politically convenient.
Which means holding large amounts of cash during a reset is like standing still on a moving walkway going backwards. You're not falling, but you're definitely not staying where you are. The second asset is more subtle. Long-term bonds. On paper, they look responsible. Predictable income, fixed returns.
safe. But that safety depends on one thing: stable purchasing power. Imagine locking your money for 10, 20, even 30 years at a fixed rate. Now imagine inflation rises or currencies weaken. Your return stays the same, but what that return can buy shrinks. There's a quiet irony here. The more secure the bond appears, the more exposed it becomes during a reset, because it can't adapt. It can't adjust. It just sits there while the world changes around it.
The third asset feels almost untouchable: real estate, property, land. People say they're not making more of it, and that's true, but they are making more debt. Real estate isn't just about land. It's about leverage, mortgages, interest rates, liquidity. And during resets, those variables